Hello everyone, and thank you for watching the Optimised monthly energy market update. I'm Mike Stafford, one of the risk managers within the trading and risk management team here at Optimised, and I'm here to talk you through the current main drivers of the energy markets as we head into August 2025. Markets remained range-bound for the entirety of July, with front-season gas peaking at 97 pence a therm on the 14th and touching as low as 89 pence a therm between the 24th and the 28th. Perhaps the most striking piece of news from a supply and demand perspective came on the 16th and the 17th of July, with an unplanned maintenance event in the Norwegian continental shelf, at which outages affected Nyhamna and Kollsnes. These resulted in piped gas volumes to the UK via Langeled dropping from 57 million cubic metres on the 14th of July to just 19 on the 16th and the 17th, calling for substantial withdrawals from UK storage. However, even this level of disruption to supply did not prompt significant bullishness in UK markets. Reaction to the outages was muted on the day-ahead market and across the curve, signalling a market lacking anxiety around availability of supply. Europe did see a potential tightening of supply from another area in mid-July, namely US LNG. Amid simultaneous heatwaves in both northwest Europe and in the Asia-Pacific region, LNG netbacks from the Gulf of Mexico briefly flipped in favour of the Asian market. In simple terms, allowing for cost of transit, price signals offered by LNG importers in Japan and South Korea briefly favoured those destinations over terminals in Europe, like Bilbao, Milford Haven, Dunkirk and Zeebrugge. However, as the month of July came to an end, Europe was back in the driving seat, with netbacks from the US's LNG heartland in the Gulf once again favouring deliveries to Europe. Staying with LNG, the 1st of July saw Canada's new LNG terminal, the imaginatively named LNG Canada, ship its first natural gas cargo. While its location on the west coast of Canada determines that the facility will almost exclusively serve the Asian market, its existence represents new LNG volume unavailable to global markets during the previous winter of 24-25, providing some new mitigation against upside price risk for the coming winter of 25-26. Similarly, this month we saw indications that Golden Pass LNG in Texas expects to begin commissioning around the 1st of October 25, adding further volume to the global LNG market. Against that backdrop, Europe's gas storage fullness crept upwards from 59% overall on the 1st of July to 68% by the end of the month. Drilling down into that, Germany remained a relative laggard at just 60% fullness by July's end, with its largest facility, Radon, just 10% full. Analysis towards the end of July suggests Europe will reach 84% fullness by the 1st of November, 11% down on the same day in 2024. While heatwaves in July saw increased air conditioning demand, seasonal temperatures are now on the downswing towards winter, which should throw sharper focus onto those fullness percentages. Uncertainty over tariffs has dogged the global economy since the Liberation Day announcement on the 2nd of April. The month of July saw a number of countries come to agreements with the US, aimed at avoiding tariffs at the reciprocal levels initially unveiled by the US president. Japan, South Korea and the EU, among others, came to arrangements with the US that reduced tariff rates on their exports by approximately half compared to those initially rolled out. This provided welcome clarity, although the specifics of some agreements, not least that with the EU, indicate a potential lack of long-term durability. The European Union-US deal incorporates an EU commitment to buy $250 billion of US energy per year for 3 years. The trajectory of European gas imports has been clear since 2022. European reliance on US exports will all but inevitably increase as the continent reduces its reliance on piped and seaborne Russian gas. However, US energy exports in total for 2024 ran to just $166 billion at current prices. Leaving aside other considerations, at the current price points, the US's existing export infrastructure is insufficient to even support exports of $250 billion. As such, this deal is predicated on an unachievable promise and invites future uncertainty as to what will happen when that promise goes undelivered. Rollout of a higher tariff regime on imports to the US from countries like Canada, India, Taiwan and Brazil, among others, also brought an element of clarity, while not being sufficient to prompt strong moves in UK gas and power markets on the 1st of August. Turning to the Middle East, the Iran-Israel ceasefire held during July with no return to hostilities. However, it's important to state that the risks associated with a potential conflict have merely eased, not been extinguished entirely. Conflict within the wider region remains ongoing, and attacks on global shipping continue. On the 9th of July, a Greek-flagged cargo ship passing through the Red Sea was attacked and sunk by Yemen's Houthis. This in itself does not represent a fresh disruption to LNG shipping. LNG carriers already avoid the Red Sea route, adding time and expense to LNG imports, cargoes of which must now pass around the southern coast of Africa as opposed to through the Suez Canal. From a technical perspective, as we've said, markets have been range-bound for much of the last month, and indeed much of the summer beforehand, aside from the brief but intense period of volatility prompted by the Iran-Israel war. At the end of April, we saw prices on the Winter 25 gas contract hit a 13-month low of 84 pence a therm, and Winter 25 power briefly dipped below £80 per megawatt hour. Week commencing 21st of July saw the bears make another attempt to set a new low, however they never challenged the lows of late April. Support held firm at around 89 pence per therm for gas and £83 per megawatt hour for power. Entering August, there is limited planned preventative maintenance scheduled in the North Sea until the final few days of the month. A handful of trade deals with the US has brought an element of clarity, as has rollout of a new tariff regime on other US trade partners. But these seem insufficient to mitigate the destruction of anticipated demand seen in the wake of the Liberation Day announcement. The tightly range-bound market suggests limited further downside opportunity in the near term. However, eventually markets will break out from their existing narrow range, beginning a new trend. With the arrival of August, there are now less than 2 months to go until the start of the Winter 25 delivery window, which will bring cooler temperatures and a sharper focus on the sufficiency of gas storage levels. Amid extant geopolitical risk, it is reasonable to suggest that upside price risk is now greater than potential downside opportunity on near-term contracts.